Hi everyone, it's Matt Barnes here. I'm the lead trainer at Safety in the Market, and in this video I want to talk about how to increase the reward to risk ratio on your trades. Before we get going, let's quickly define the term reward to risk ratio. You may see it described elsewhere as a risk to reward ratio, but for this video I'm going to call it reward to risk ratio. If you're right on a trade that you take, you'll make money from that trade, and we call that money your reward from the trade. If you're wrong on a trade, and you will be wrong on a trade from time to time, but if you're wrong, you're going to lose money on that trade, and we call that money your risk on the trade. So we look at your reward, how much you can make if you're right, and your risk, how much you're going to lose if you're wrong. And if you divide your reward by your risk, we call that your reward to risk ratio. So if your reward is $200 and your risk is $100, that would be a 2-to-1 reward to risk ratio. And that tells you that for that amount that you're risking on the trade, you're expecting to make at least 2 times that risk. And that's really important. In the video that I recorded called Trading the Easy Way, which you can find here on our Safety in the Market YouTube channel, I spoke about 2 ratios that determine how profitable you will be as a trader. One of those was the success ratio, which tells you how often you're correct in your trading. So are you right 3 times out of 10? Are you right 7 times out of 10? The other ratio is the reward to risk ratio, and that tells you how much larger your winning trades are than your losing trades. Well, hopefully your winning trades are larger than your losing trades. Now, at the end of that video, I showed you that if you want to trade the easy way, the simple thing to do is to look for trades with a higher reward to risk ratio. Personally, I look for trades with a 10-to-1 reward to risk ratio, and that's what the Safety in the Market Active Trader program recommends for you as well. To target trades with 10-to-1 or more reward to risk ratio. And I can promise you, once you've taken a trade with a 10-to-1 or more reward to risk ratio, you'll never look back. You'll never settle for a 2 or a 3-to-1 reward to risk ratio again. So in this video, we're going to look at reward to risk ratios, and we're going to approach them from the angle of how can we increase the reward to risk ratio on our trade. And we're going to do that by looking at this move on the Nasdaq leading into the top of 2021. So we had a move there that you can see starting at the bottom left of the screen, starting on the 4th of October 2021 and running up to the 22nd of November 2021. So the market ran up for about 7 weeks. Let's assume that you correctly identified the trend of the market and you saw that it was going up, and you entered the market buying at 15,002 points. The Nasdaq works in points. If that confuses you, just treat that as $1 per point. Let's say you bought the Nasdaq at 15,002 and you had a stop loss at 14,365. That amount would be your risk on the trade. Now, depending on how many contracts you buy and how big a trader you are, how big your trading account is, that risk amount will be different for every trader. Similarly, the profit or reward on the trade, which is from where you get in at 15,002 all the way up to this profit target at 16,700, it's going to be the same amount of points for everybody, but depending on how many contracts you buy, the dollar amount is going to be different. When it comes to reward to risk ratio, keep in mind that reward to risk ratio doesn't take dollars into account. It's just a simple ratio. 2 traders can take this. One, a brand new trader with $5,000 in their account, and the other one, a seasoned professional with millions of dollars in their account. They could both take this trade and buy at the same point, sell at the same point, and set a profit target at the same point. And while the professional trader with the much bigger account will make a lot more money, their reward to risk ratio here would be the same. So that's very important to note. See if you can have a go at working out the reward to risk ratio on this move using those 3 figures there, buying at 15,002, having a protective stop or stop loss at 14,365, and setting a profit target at 16,700. By the way, that is a top that we were expecting well in advance, and it's a top that we spoke about, or a target area of around that 16,700 mark for several months leading into that top. But we're going to talk about that in another video. But just know that that top was actually predictable in advance. So, did you work out the reward to risk ratio on this trade? Let's have a look. The entry point was 15,002 and the stop loss was at 14,365. Our risk on the trade, therefore, is our entry price minus our stop loss price, and that's 637 points. You can do this calculation the other way, stop loss minus your entry, and it will give you the same number, but with a negative sign in front of it. So just drop the negative sign, and your risk on the trade there is 637 points. For our reward, we take our profit target and we subtract from that our entry price of 15,002, and that gives us a potential reward of 1,698 points. If it helps you, just treat those as dollars. Let's just imagine we were trading the Nasdaq at $1 per point. So that would be $637 in risk and $1,698 in reward. So that gives us a reward to risk ratio of 1,698 divided by 637, or 2.66 to 1. And importantly, what that means is for every dollar you risk on the trade, if you're right, you will make $2.66 in profit. So if you build a position size and you're risking $50, we're going to make 2.66 times your $50. If you build a position size where you're risking $10,000, you're going to make 26,600, etc. Now, 2.66 to 1, is this a good result? We saw in the Trading the Easy Way video that conventional wisdom tells us that's not a bad result and you can be profitable with a result like that. However, for me, I think 2.66 to 1 is a poor result. And as a matter of fact, if I saw a trade like this where the reward to risk ratio was only 2.66 to 1, I wouldn't take it. It doesn't matter how good the trade looked, even if I only had to be in the trade for a short period of time, although keep in mind here on the Nasdaq, you needed to be in that trade for about 7 weeks. But even if it looked really good and I could be in and out very quickly, I don't think 2.66 to 1 is an adequate reward if I'm putting my money on the line. But that's me as a trader. As I said in the previous video, I believe that if you want to trade the easy way, you focus on opportunities where you have a large reward to risk ratio. And sometimes the large reward to risk ratio just isn't there. And in those cases, the good news is for us as traders, you simply don't take the trade. David Bowden, the founder of Safety in the Market, has a brilliant saying. He said, the biggest advantage that you've got as a trader is that you don't need to be in the market all of the time. Think about that for a moment. There are fund managers out there who their mandate says they must have every dollar that they're managing in the market at any given point in time. So think about the 1987 stock market crash. Think about the September 11, 2001 market collapse, the tech wreck of 2001. Think about the global financial crisis in 2008 and 9. Think about the COVID-19 crash, which we saw in March of 2020. Markets absolutely collapsing. There are people out there who had to have their money invested in the market. We didn't. If we don't see a good opportunity as private traders, we don't have to be in the market. We can just say, nope, that's not good enough. I'll come back tomorrow and I'll have a look. And just remember, that's a massive advantage. David said it's the biggest advantage you've got. And he said too few traders actually take advantage of that. So this 2.66 to 1, we're going to try to increase that now. But first, have a look at this picture. This is taken from Profit Source Software by Hub Financial Group, HUBB. And this shows you the trade. If you buy at 15,002, there's your entry over here. And you put your stop loss down here. That's your risk on the trade. That's in red. And then your profit target up here, 16,700. Down to your entry here at 15,002, that is all of your potential reward. So this is actually using the risk to reward tool in Profit Source software, but I just want you to focus on the colors there. The reward here in green divided by the risk in red gives us our reward to risk ratio, which here you can see is 2.67 to 1. It's about 2.665. I rounded it down, the software rounded it up. I always like to be conservative in my estimates. If we want to increase this reward to risk ratio, think about your reward, think about your risk. What can you do to either of those to increase the reward to risk ratio? The first thing that you could do is you could increase the reward on the trade. So you could target a bigger and longer move in the market. That's one thing that you could do. Secondly, you could look to decrease the risk on the trade by getting in earlier. But they are the only two things. There's no other way that you can increase the reward to risk ratio. You've got to do one of these two things. You can increase the reward or you can decrease the risk. Now, some people will say, well, I'll leave the reward to risk ratio the same, but I'll just buy more contracts. And then if I'm right, I'll make more money. I'll increase my reward. Just keep in mind that if you increase the reward that way by taking more contracts, at the same time, you're increasing your risk if you're wrong. So if you're right, yes, you'll make more reward. But if you're wrong, you will lose more money because you've increased your risk as well. So let's explore this in a little bit more detail. We want to increase our reward to risk ratio. Let's keep it simple and say we'll try and double our reward to risk ratio. What could you do? Well, you could double the reward or you could halve the risk. Either of those two outcomes is going to double your reward to risk ratio. So let's do this example on the Nasdaq. We had a risk of 637 points and we had a reward of 1,698 points. And that gave us a reward to risk ratio of 2.66 to 1. Let's double the reward to risk ratio by doubling the reward. The new reward becomes 3,396 points. And our new reward to risk ratio becomes 5.33 to 1. Before I show you this on a chart, can you think of any problems with this approach? I can think of a big one. It means the market now has to go further for us to achieve this higher reward to risk ratio. And that also means that we're going to need to be in the trade longer as well. Now, there are no guarantees that the market is going to go further. And in fact, if we look at this on the chart, you can see that in this case, our new target of 18,398, the Nasdaq didn't reach there. It stopped around that 16,700 level and then turned around, made a double top, and then collapsed from there. So in that case, you can set as large a reward as you like. You can say, I'll set my profit target at 100,000. And that will give you a reward to risk ratio of over 100 to 1. But it doesn't mean the market is going to get there. So by increasing the reward here and looking for the market, trying to squeeze even more out of the market, we're also increasing our risk of being wrong on the trade. Yes, the reward to risk ratio was now 5.33, but there's no point in having a higher reward to risk ratio if the market's not going to get to your profit target. And as I said earlier, for months leading into this top, it was pretty clear to safety in the market students that if the Nasdaq got to around 16,700, there was massive resistance at that point, massive. Multiple price forecasting elements, multiple price forecasting milestones, all clustering around that point and forming what we call a brick wall that the market was going to have to push through. And it was almost certain that the market was going to turn around. There's no such thing as a guarantee in trading, but it was a very good looking trade, a very good looking setup at that 16,700 level. And safety in the market students with the Active Trader Program online training might like to go through and revisit their training and also check out the Trading Essentials webinar that I recorded in November of 2021, where we looked at that top live and I said, I think that's it for the rest of the year. I think that's the yearly top. Let's look at the alternate scenario now. Let's look at halving the risk on the trade. So if we halve the risk, our risk was 637 points and our reward was 1,698 points and the reward to risk ratio was 2.66 to 1. If we halve our risk, that gives us a new risk figure of 318 points. That means our new reward to risk ratio would be 5.33 to 1. So how would that look? See how there's a lot more green now and the red is just a little bit smaller. Our target is still the same at 16,700. So we're not asking the market to do any more, but we're putting our stop loss a little bit closer to the market. Now, I've just randomly chosen these numbers here. Obviously, professional traders will have a trading plan and we will want to put that stop loss in a key technical position. And that's something that your trading plan is going to tell you how to do. But if you can reduce the risk there by 300 points, that means that the market doesn't have to go another 1,700 points to get you your 5.3 to 1 reward to risk ratio. So those are your two choices if you want to turn the 2.66 to 1 into a 5.34 to 1 reward to risk ratio. You can ask the market to go an additional 1,698 points, or you can tighten your stop loss on the trade and reduce that risk by only 318 points, and that's going to do the same job for you. Now, again, it's not always possible to do either of these. What I'm pointing out here is that by far the easiest way to increase the reward to risk ratio on your trade is to do it by reducing the risk. And many times, if you can reduce the risk and get in a little bit earlier, you're also going to increase your reward anyway. But if you want to affect that multiply, if you want to affect that ratio in the biggest possible way, it's easiest to do it by reducing the risk on the trade. Now, it's very easy to say, oh, we'll just reduce the risk on the trade. But the question is, how do we decrease the risk on the trade? We know that decreasing the risk is going to give us a bigger reward to risk ratio. And sometimes it's going to massively increase your reward to risk ratio. So how do we decrease the risk? You do that by entering the trade earlier in the move. So you have to be on the ball for this if you want to get the optimal reward to risk ratio. And there are two ways that you can enter the trade earlier. The first way is to enter the move using a shorter term time frame. And what I'm talking about there is the trend of the market. And that's a little bit beyond the scope of this video. But think about long-term trends in the market and short-term trends. The short-term trend may unfold over a few hours or a few days. A longer-term trend may unfold over several months or even several years. And there are all sorts of trend timeframes in the middle of that as well. The concept I'm talking about here is identifying a long-term trend and then getting set in that trend as early as possible, perhaps using a shorter term time frame. And if you want to know how to do that, check out our Active Trader Program online training, and you can see the link for that in the description. The other way to enter a trade earlier is to use price forecasting skills to get in close to the highs and lows in the market. We call these the turning points in the market. Another way of describing the high or the low in the market is the start of a new move. If a market like the Nasdaq runs up into a top, that top is the end of the run up, but at the same time, it's the start of a new run down. So for example, here on the Nasdaq, we had a trend that was running up. So we had a higher top, higher bottom, higher top, higher bottom, higher top. So that's the uptrend running up there. Then the market turns around and starts heading down. So this top up here is really the beginning of a new trend to the downside. And if you can predict that top, you can actually get set in a trade, whether that's picking a low to get into a long trade early and make money as the market goes up, or whether that's picking the top of the market so that you can get set with a short trade early in the move and make money as the market falls. Either way, price forecasting can get you very close to that top or very close to the bottom and get you in very close to the start of the move. And if you're getting in close to the start of the move, for example, you might enter here, 100 points, maybe 200 points away from the top, and you can put your stop loss above the top, and all of a sudden your risk is only 200 to 1. And if you're targeting a 2,000 point move in the market, well, 2,000 points of profit, 200 points of risk, that's how you get a 10 to 1 reward to risk ratio. Now, we're going to talk about these concepts in more detail in later videos, but just think about those two concepts. Being able to follow the trend of the market. I do that using charts like this, which are called swing charts, and they're taught in the Active Trader Program online training as well. But I use swing charts on multiple timeframes to give me my short, medium, and long-term trends. And then I use another concept called price forecasting. Specifically, I use 3 techniques in price forecasting. And when all my numbers line up, I have a very good chance of calling a top. Like this one here, I called 16,700 months before the market got up there. Now, if you've never seen a price forecast before, you might be thinking, oh, that's easy to say in hindsight, but you can't do it in foresight. Don't worry, I used to think that way as well when I first heard of David Bowden's price forecast for the 1989 top, which he called correct to the point 1 year in advance and published. So it can be done, but what I want to point out is that not every single forecast that you do is going to come out perfectly. And that's why people will look at it and they'll say, oh, you got that one wrong, so price forecasting doesn't work. But what people don't realize with price forecasting is that when your price forecast is wrong, normally either the market won't get to your price, so you don't take a trade, or it will burst straight through your price without giving you a trade either. So I look at a failed forecast as just a non-event. It didn't happen. The market moves on and we look for the next opportunity. But when they're right, that's where you can set up for trades with a 10, 15, 20, 30 to 1 reward to risk ratio, as we saw in the Trading the Easy Way video. Now, as I said, I'll talk more about these concepts of following the trend of the market and finding these turning points in the market in a later video. But for this video, I just want you to focus on that idea of reducing your risk to increase your reward to risk ratio. Don't squeeze the market and hope that it's going to run onto higher and higher prices. Focus on honing your skills so that you can get into these moves earlier and have that larger reward to risk ratio straight away. So in summary, you can improve your reward to risk ratio on a trade by increasing the reward or by decreasing the risk on the trade. In my opinion, it is far easier to decrease the risk on a trade than it is to increase the reward on the trade. And the way to do that is to get into your trades earlier by following the trend of the market and finding the turning points in the market. So learn swing charts, learn price forecasting, and focus on picking those turns in the market. As I said earlier, picking the turns, there are 3 techniques that I use, and Fibonacci levels is not one of them. If you'd like to learn more, you can check out our Active Trader Program online training by clicking on the link in the description. If you're new to the channel, welcome and thank you for watching. I hope you enjoyed it. If you learned something from the video, click on the like button, and if you'd like to subscribe, you can keep up to date with all of our future videos as they're released. In the next video, I'm going to take you through how price forecasting works, and you'll see just how it's possible to call price pressure points in the market, like that 16,700 top on the Nasdaq, well before they happen. So until then, all the best with your trading, and bye for now.